Today, I'm doing a complete financial analysis of Palantir. I'm showcasing the things that I love about the company and I highlight the areas where I want to see improvements. At the end, I'm telling you why I'm not buying Palantir stock yet and what I believe to be the true intrinsic value of the company. If you want to gain a better understanding of Palantir business, you can do so by watching this video. Let's see how healthy the company truly is. And we're gonna start by looking at the most important aspect, its revenue growth. If a company doesn't grow its revenue, it is generally not a good investment since it can't improve its ability to generate free cash flow. Unfortunately, the revenue growth crumbled. With such a strong product offering, even considering the macroeconomic difficulties, the growth for the fourth quarter is disappointing. Let's see more precisely the areas where Palantir is struggling. When analyzing Palantir's business units, the governmental side of the business is still the cash cow, with around 57% of total revenue coming from the governmental side. In terms of revenue growth, in the last year, the commercial side grew massively, around 45% year over year, but following the last quarter's results, the growth slowed suddenly, while the government business reignited its growth with 26% year over year growth. From a geographic perspective, Palantir is mostly concentrated in the United States with 62% of the revenue and the UK with 12%. Moreover, the US and the UK are also growing the fastest, as the rest of the world is seriously lagging. This is the first red flag which showcases that Palantir is seriously struggling to capture market share outside of the US and the UK. However, the fastest growing area is the US commercial business. It grew more than 100% during the last quarters, but unfortunately it slowed down tremendously with 53% year over year revenue growth. The US commercial represented around 18% of the total revenue, growing from 11% just 1 year ago. One major area where Palantir struggles is its commercial business outside of the US. Palantir has difficulties penetrating the markets outside of the US with their Foundry product. Even if the company doubled the number of customers at the end of 2021, its revenue grew modestly, around 16% in the same period. To sum up, Gotham is still Palantir's cash cow, US is still the biggest market, and Palantir has difficulties selling Foundry outside of the US. Regarding margins, gross margin is arguably one of the most important for a business. If a company has a low gross margin, it generally doesn't have enough money to reinvest in growing the business. As many other software companies, Palantir has a great gross margin, around 78%. This shows that the company has operating leverage and can grow fast without high amounts of investments needed. Next, let's look at the operating margin. The difference between the GAAP and adjusted operating margin is the stock-based compensation. The trend improved significantly in 2022 when GAAP operating margin was sitting around minus 13%. To understand exactly where Palantir improved, let's analyze the operating expenses individually. In the second quarter of 2021, the sales and marketing became the biggest spending area as Palantir focused on expanding its sales force to capture more market share, especially for its commercial business. Before going into the risks involved with investing in Palantir stock, let's see how much free cash flow is the company generating. Remember, even if a company isn't GAAP profitable, it can still generate cash, and that's one of the most important metrics for a fast-growing company. Palantir's ability to generate cash has been weaker during the last 3 quarters, with a free cash flow margin as percentage of revenue sitting around 7%. This is significantly lower than the 24% registered 1 year ago. And while you might be thinking that's not so bad since Palantir generated cash flows consistently, this is not true. Since the free cash flow statement adds back all the stock-based compensation that the company pays to its employees, this makes it look like the company actually generates free cash flow. However, if you take a look at the stock-based compensation amounts, these are much more significant than the free cash flow generated, so if you take this into account, Palantir has never generated any free cash flow.
Man, what?
Still, as a way to keep track of both fast growth and free cash flows, the management follows closely a software operating KPI called the Rule of 40. Rule of 40 tells us how fast we can grow without burning too much cash. Unfortunately, Palantir's Rule of 40 is at an all-time low, with 22% revenue growth and only 7% free cash flow margin for the third quarter. This shows that in spite of investing in growth, Palantir's output is for now disappointing. I will closely watch the Rule of 40 as I want to see an improvement in this metric before investing in Palantir. In terms of customers, US commercial customers grew 124% compared to 71% for international. This is another proof that Palantir's Foundry has more success in the US, but it still managed to land important deals outside of the US in the last quarter. The most important metric regarding customers is the net retention rate. This shows how much do customers like the platform, and it is calculated as the expansion of recurring revenue from existing customers compared to 12 months ago. Generally, a net retention rate above 120% is a great value. Palantir saw its overall net retention rate decrease during the last couple of quarters, sitting now just shy of 120%. Moreover, at the end of 2021, the government business had a much better retention rate, especially outside of the US, with more than 160%. On the other hand, the commercial business outside of the US is again seriously lagging, with a net retention rate of only 103%. Since Palantir managed to sign many new customers recently, let's see how future demand looks like. Palantir offers us two important metrics that we can use. Firstly, the total remaining deal value is the remaining value of signed contracts, but the majority of these contracts can be cancelled at any time by Palantir's customers. On the other hand, the remaining performance obligation represents non-cancelable contracted revenue that has not yet been recognized. When looking at the trend for the two metrics, we can see that even if the total deal value grew by 600 million, the RPO only grew by 100 million, which means that many of the contracts signed by Palantir can be cancelled. Considering the high chances of a recession in 2023, I believe there's a high probability that some of these contracts will be cancelled, generating a period of high volatility in Palantir's business. But if more deals are coming in for Palantir, why is the revenue guidance for the next quarter for only 16% growth? One possible reason is a high churn rate, which shows how much of the contracts do customers cancel. One crucial metric that Alex Karp offered us in the last earnings report is the total contract value that was signed in the current quarter. Using this metric, we can approximate the amount from contracts that the customers cancelled. The second quarter of 2022 was by far the worst, when customers cancelled almost $320 million. I expect this amount to increase, especially if a severe economic recession materializes. Palantir uses the contribution margin as its key operating metric. It is defined as revenue minus cost of goods sold minus sales and marketing expense, excluding stock-based compensation. Palantir argues that they exclude the stock-based compensation since it's not a real cash expense. However, this confirms that the contribution margin is skewed, since it doesn't incorporate an important way of financing for Palantir. In spite of the slowdown in Palantir's business, I still believe that the company has tremendous potential, and there are three main reasons for that. Firstly, we have the high barriers to entry. Next are the high switching costs. If the development team build a unique solution on Palantir's platform, the switching costs will be significant. Lastly, customer activity informs Palantir of future opportunities, which translates into network effects, which is the best type of moat. More proof that Palantir has a strong competitive advantage are offered by International Data Corporation, who named Palantir the #1 artificial intelligence software platform in terms of both market share and revenue in 2021. Moreover, independent research firm Forrester also named Palantir a leader in AI and machine learning platforms. In terms of risks, there are two main risks for Palantir stock. Firstly, during the second quarter's earnings report, Palantir abandoned its long-term growth objective of 30% revenue growth. It was the first time that Palantir showed weakness and made us realize that its investments might take more time than expected to pan out. The second risk is a delay of GAAP profitability. Focused on capturing more market share, Palantir hasn't proved that it can become profitable.
That combination of radical optionality on expenses and what we perceive to be macro conditions converging with product conditions allow us to kind of see what we think will be a profitable company in 2025. In
terms of valuing Palantir, I value the company using the most accurate method available, the DCF. For right now, my price target is around $10.5 for the base scenario. However, since no one truly knows the exact inputs for the analysis, I believe the true intrinsic value of Palantir is somewhere around these values, depending on the inputs used for the weighted average cost of capital and for the terminal free cash flow growth rate. In terms of technical analysis, since it has a high growth profile with no signs of GAAP profitability, the stock is very volatile and I expect it to swing between $7 and $9 in the following months. Please be aware that we find ourselves in a very difficult to navigate market. With recession fears mounting, Palantir stock will also be affected and it will probably make a lower low. Although Palantir has plenty of potential, I want to see a recognition in the growth, especially in the commercial business, kind of what the governmental business did right here. At the same time, I will closely watch the churn rate to see how much of the contracts do Palantir's customers cancel, as well as the Rule of 40. Remember that if a severe financial crisis materializes, there's no stock that can escape the short-term pain. That's it from me. Until next time, keep crushing it and subscribe.